We didn't have the best of days in the market, as we can see, red pretty much right across the board, and one of the industries that was hit the most was the semiconductor space, one that seems to continually be in the spotlight. Nvidia down 7%, the same as AMD, and we had some news that you could argue justified these drops, and that has also affected investor sentiment. Whilst we were starting to climb out of extreme fear, we've started to come down even lower, and perhaps it does make sense given where we are in the global economy. But the main reason that we did get the semiconductor stock drop, which for the large part did affect Nvidia and AMD, were higher costs that were associated now from exporting their products to China, and we can see Nvidia yesterday came out and said they expect a $5.5 billion charge, which, as we showed in yesterday's episode, sits around more than 10% of their top line revenue from just their latest quarter. And AMD also said they weren't immune to this. They expect a charge of up to $800 million. And we can see ASML, again, we reported on this yesterday, they didn't have the best of earnings. They missed their order expectations. And again, tariffs is creating a lot of uncertainty in demand as well as future guidance. Now, Nvidia has come out not only saying they will anticipate that $5.5 billion in costs, but that they will also abide to the US government, what they say in terms of export controls, and they will essentially not create any issue and effectively take this on the chin. But today we want to cover one of our favorite semiconductors due to the valuation, that is Taiwan Semiconductor Manufacturing Company, which after reporting their earnings, which we're covering today, is up around 2 to 3% in the pre-market. Over the last year, up 8.5%. Year to date, down nearly 24%, pretty much losing nearly 1/4 of their market cap just in 2025 alone. But over the last 10 years, as we will come to show you, they've still managed to massively outperform the S&P 500, trading near their 52-week low, quite a pullback from their all-time highs at $227. And probably the one thing that has caught your attention is that Seeking Alpha, Wall Street and Quant still give this company a strong buy. This is incredibly rare, not something we see that often, if other than this company, and we'll also touch upon their forward valuation around the 17 mark, as well as their dividend around 2%. Now firstly, let's dive into their latest quarterly earnings, Q1 FY25, where revenue was up 35% year on year, and for those that don't know, the vast majority of their top line is made up of high performance computing, around 59%, with smartphones sitting around 28%. Quite interesting to note as well, on a year-on-year comparative, high performance computing is up 13 percentage points, whereas for smartphones we do get the opposite, a drop of 10 percentage points. The other thing we love about this company, not only is their revenue increasing over time, but we're seeing efficiencies to all of their margin. Gross profit up 6 percentage points, operating up 6 as well, and their bottom line up 5. Remember, high quality companies not just showing us an increase to revenue, which we pretty much note from the majority, but also improvements, efficiencies to their margins. Now diving straight into the narrative of their earnings, and one thing that investors wanted to see, which was a nice sigh of relief, is that they are sticking with their revenue forecast. They're not revising it given the uncertainty that we are seeing in tariffs, and that they also outperformed in terms of the bottom line expectations. We can in fact see net income is up 60.3% from the same quarter last year, and revenue is up 41.6%, and this is largely attributed to the strong AI chip demand. And no surprises, they aren't stupid. They do accept that they will face some headwinds from the trade policy of Donald Trump. Something that is really uncertain at the moment, continues to change on a day-by-day, week-by-week basis, and we do need to try and gauge the tariff implications for Taiwan Semiconductors as well as other companies we are considering investing in. Now if we just take a deeper look and see some of the points from their earnings, first thing, for those that like to compare them against analyst expectations, revenue $839 billion, above expectations of $835, and as we said at the beginning, bottom line $362 billion, well above expectations of $354. The other thing to note here, as we've already pretty much covered earlier on, is that their high performance computing, which is made up of AI as well as 5G, makes up 59% of their total revenue, and it was nice to see that was up 7%. And one thing that maybe is a little bit understated, something that we do believe is incredibly important, especially given the climate we are facing at the moment, is that when we're looking at companies, we also need to see what are they guiding, whether or not in fact they are changing. And Taiwan Semiconductors, very nice, something investors always want to hear, especially during these uncertain times. They've maintained their forecast for the growth of revenue in 2025 to sit around the mid 20% point, and that is also considering the issues we're getting in tariffs as well as the new AI chip export restrictions. Also, not sure if you do remember, but it wasn't that long ago where we heard that the company was investing an additional $100 billion in US facilities, which should help some of the issues and the headwinds that they are expecting, at least in the shorter term. And whilst it may have been reported not too long ago, they have effectively come out and said that there is no joint venture talks with Intel. In fact, they're not engaging in any discussion with companies regarding any joint venture, technology licensing or technology. And also some very good news for the company is that effectively AMD will soon be manufacturing their processor chips at one of their new Arizona-based facilities, and that is the first time their chips will be manufactured in the US. And we also got to see something similar for Nvidia, where they've announced they've already started production of their Blackwell chips at their Arizona plants, and they plan to produce up to $500 billion of AI infrastructure in the US over the next 4 years through their partners, and one of those is Taiwan Semiconductors. So lots of good news, especially this investment into the United States for Taiwan Semiconductors will help a lot with their tariffs, will also help with any potential additional headwinds that maybe we can't see at this point in time. And there's also the geopolitical risk that we do have between the US and China, especially over Taiwan. Now that is one matter that is separate to others that we have discussed, so something also for you to consider. But what we do notice is that the first phase of the US tariff talks between Taiwan and the US look to be going well, but as we discussed, they also have their Arizona plant, so lots of good news for TSMC, we would say, at this current point in time. And just for those that do like to see the comparison, not just against the same quarter last year, but if you do want to see it from just the previous quarter, well, their revenue is in fact slightly down, their gross margin and in fact their operating margin, we would say, is very similar, including their bottom line. But if you want to look at it from the same quarter last year, lots of growth on the revenue, 41.6%, margins improving as we've already covered. But one thing we are trying to draw your attention to this when we do compare it to the same quarter last year, like we said with ASML, this is a fairly cyclical company, so whilst we may see growth over the longer term, so don't be surprised to see a bit of a bumpy road when you look at it on a quarter by quarter basis. And they've also said in their future outlook, something we've already covered, but they stand by their 2025 revenue regardless of this ongoing tariff situation. Top line increase for the full year around the mid-20s, and in fact this is something they anticipate for at least over the next 5 years, revenue to be compounded on an annual growth rate at 20% year on year, longer term gross margin to be 53%. That is very strong. We'll also compare it shortly to the sector comparative, and their return on equity to be greater than 25% through the cycle. Again, lots of very good news. And they've also gone on to say at this current point in time, they've not seen any changes in their customers' behavior with regards to uncertainty and risks from the potential impact that could be in play when we do think about the tariff policies and any continual changes. However, it is something, and we aren't surprised to see that they are closely monitoring. Now, great to see. This is a company that does typically outperform against analyst targets, something we also noted in quarter one, and they also expect the next 4 quarters to show some growth, which is always great to see. And if you do look at it based on December 2026, then the forward valuation does sit around 14.3. Now, talking about it just in terms of the next 12 months, they're trading at a valuation of around 16.7, significantly below the 5-year average of 22.1, so we would call this a severe undervaluation signal. However, when we take a look at it in terms of the yield, pretty much offering the same it has done on average over the last 5 years. The other model we look at here is based on the 5-year average of the P ratio. First thing, Blue Tunnel, it is telling us the expected fair price. Always great to see this increase over the longer term. That is something you want from companies you're invested in, but for the first time over the last 12 months, we have seen it outside, in fact below the bottom end of the Blue Tunnel. This, given the disparity, does tell us right now another severe undervaluation signal, and will also tell you, whilst it does get a C- on the valuation grading, they are trading below the sector median of 18.6, so you're getting a 10% discount, one that we will come to show you actually deserves to be trading at a premium, so a great opportunity to consider today. And when we look at it in terms of their 5-year average at 22.5, again something we highlighted, they're trading lower. So not only is this company, as we can see here, given the negatives, trading at a discount to what they have done over the last 5 years, but for the majority of other metrics in terms of the valuation space, this company also trades at a discount to the sector. So definite opportunity in our opinion, at least to consider at the bare minimum. And if we look at institutional ownership, sits at 16.5%, 16 billion worth of selling over the last year. We get nearly 50% more in terms of buys at 21.3, and we also notice a lot more buying in the most recent quarter. So clearly institutions over the last year and in the most recent period are very bullish on Taiwan Semiconductors, although as we always say, we need to do our own due diligence and can't rely on what they do. The other thing we like to do is consider what super investors are doing. Now for quarter 4, we are talking about now quite a while away. We do notice a bit mixed. Some super investors were selling, some were in fact buying, but now we have got some of these super investors portfolios, and we can see Dodge & Cox, they bought this company. It is a new position in the most recent quarter. We're talking January to March, around 15.8 million worth of shares. Now it is very small in relation to their portfolio, only 0.39%. We can in fact notice they don't have large positions. In fact, their largest one is just over 4%, and this is a portfolio value of $112 billion. Now let's jump into the company, the underlying metrics, always great to see. First thing, dividend safety comes in at 62 safe. Now we've already covered these valuation models, but great to see in the most recent dividend increase, November 2024, it was a 12.5%, which is always good to see, significantly above the minimum 4%, which we would say just to keep up in line with inflation. And we can see their dividend safety reaffirmed beginning of this year, effectively meaning a dividend cut for Taiwan Semiconductors is unlikely. And if we look at the key metrics, remember again, this is how they performed in the 07-09 Great Recession. They actually cut the dividend, by the way. They didn't increase it. They didn't maintain it. They had below average growth, negative 26%. S&P itself, negative 12. But they massively outperformed, negative 25. S&P, negative 55. And as we said, not only a very juicy dividend increase in November last year, but over both the last 5 and the last 10 years, they have continued to increase it at a very rapid rate. And we do notice, whilst they've only been increasing the dividends for the last 2 years, they've been paying a dividend for the last 21 without a reduction. As always, we do focus on free cash flow on this channel as opposed to the earnings data, which is susceptible to manipulation by management through accounting. Below 50% is what we want for the semi space. Now we can see very inconsistent, but nice to see in 2024, 51%, and over the next 12 months around 59%. So we should expect those double-digit dividend increases to continue. Now free cash flow per share, remember this is in a cyclical industry, so whilst it has pretty much tripled over the last 10 years, the increases aren't consistent, which is something we'd ideally like to see, but again, bear in mind the industry, and a small drop is anticipated over the next 12 months. In terms of sales growth, again, we do see that cyclicality, no real consistency in the numbers, but more often than not, top line increase is very large, 34% in 2024, and remember they anticipate mid-20s increase in 2025, and that expected to continue over the next few years. If we look at it, however, from a numerical basis, we can see such a very rapid increase over the last 10 years, and if we look at shares outstanding, definitely something that they aren't considering. Whilst we love it when we see this reduce, as it does return excess cash to investor pockets, it has stayed flat over the last 10 years, so it looks like this isn't something they will continue moving forwards either. However, who knows, we can keep our eye. ROIC, one of our favorite metrics, 12% or more for the semi space, gives us faith management are able to effectively allocate their capital, very consistent in the mid to upper teens, 19 on a trailing 12-month basis, and operating margin, as we said, not just companies increasing their revenue, which we note from TSM, but also operating efficiency. Very good to see, 38 10 years ago, now sitting at 46, and free cash flow margin, 5% bare minimum. We see a lot better year on year, yes, inconsistent, but still very healthy, 30% in 2024. And then we move to the net debt to EBITDA, our favorite metric, and we'll explain why. It shows us the number of years it would take them to pay off all of their debt net of cash on hand. We want below 1.5 for the semi space, correlates to dividend safety, balance sheet strength. Over the last 10 years and over the next 12 months, it isn't expected to take them even one day to pay off all of their debt. Very, very strong balance sheet, and we'll also confirm that shortly. Now, in terms of the growth grade, they do get an A-. Year-on-year revenue, 34%. Forward-looking, 25%. Well above the sector in the mid-single digit. Remember as well, they are trading at a slight discount to the sector, and they're also growing faster in the last 5 years at 21% and 17% respectively, whilst also anticipating EPS growth to be very strong over the next 3 to 5 years. years, 30% year on year, well above the sector at 14% and well above their own 5-year at 19%. Profitability also looks very strong at an A+, gross margin 56%, well above the sector at 51%, slightly above their 5-year at 54%. Bottom line 41%, again well above the sector at 4%, also marginally above their 5-year. As we showed you as well, we are noticing operating efficiencies, and cash from operations 56 billion, well above even their own 5-year at 40 billion, and significantly above the sector at 106 million. And remember, this is a company that has a strong buy right across the board. Now we can also show you how their performance has been against others in the space. We have Broadcom, Qualcomm, AMD, TXM, ARM Holdings. And one thing we do notice is over the last year, not the greatest performance, they're up only 10%, but just look at others in the industry. In fact, they're one of two alongside Broadcom that has actually had a positive return just over the last 12 months. And if we expand it to over the last 5 years, second best up 217%. Bear in mind, this is including reinvesting those dividends. Again, second to Broadcom up 668. And then when we zoom out even further, they are still very strong, up 707%, but they are the third best. As we can see, Broadcom extremely high, 1,791, with first place AMD 3,739. But important to understand, past performance is not an indicator of the future. The other thing we'll highlight is their performance against the S&P, which they have marginally outperformed over the last year, up 10%, S&P 4.44. Over the last 5 years, we see that massive outperformance, 217%, S&P 88, and over the last 10, it has continued 707, S&P 155. As always though, give us your thoughts. Do you believe they can continue to outperform the S&P over the longer term? And whilst we did already highlight their revenue, which as we can see has grown very consistently and rapidly over the last 10 years, going from 25 billion, more than 3 times in fact, to 88 in the most recent annual accounts. But what we want to identify here, something that we haven't considered yet, is the bottom line net income. Does it tell a similar consistent story? And the answer for the large part is yes. As we can see, it has in fact more than tripled from 9 billion in 2015 to 36 in the latest annual accounts. So it does look very strong from an income statement perspective. And then if we do a very quick health check, total cash versus total debt, cash has only been increasing over the period. 18 billion in 2015, now sitting at 74 billion. That is a very large amount, but as always, one number in the balance sheet won't give anything away, so we compare it numerically and directionally to their total debt, which as we can in fact see, it has been increasing over the period. So we do in fact notice going from 7.7 billion to now sitting at 32, but as we saw, cash balance is far superior. It won't even take them 1 day, as we highlighted earlier, to pay it all off, so absolutely incredible to see, and definitely one of their strong points. Now, just before we do jump into our valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to grab a copy of 35 severely undervalued stocks for the month of April. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab just a very recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now, jumping to our intrinsic value in today's episode, we get to $226, derived as the average of these 3 models that we are going to run through now. Firstly, we start off with the multiples valuation model. Companies similar sector and size, their P multiple average multiplied by the EPS of TSM to get our first intrinsic value showing undervaluation. Bear in mind though, we're not looking at any one of these models in pure isolation. Then we get to the dividend discount model. Very strong increases, as we did already highlight. Average around 15%, so we have gone lower at 7 to get another very large undervaluation signal. And then we move on to the DCF model, where we have the free cash flow year on year, average growth year on year 55%. We've gone a lot lower than analyst expectations as well at 16%, with the discount rate giving us the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to $220, a third undervaluation signal. And as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for TSM or any others, but 226 as the average, with the current price at 155. And we're not done there, because we always apply a MOS. 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, then a buy at $203, but we're not done, because we do then keep going till it's near the current trading price. And what we're saying in today's episode, not a 35% MOS just yet, that would be a buy at $147, but you're getting at least 30% up to $158. Now, there are some other things to consider. Yes, tariff uncertainty may affect their numbers, but also we have that continual geopolitical tensions with China as well. Maybe you want a larger margin of safety. So as we said, 35, a buy at 147, at 40, around 136. So 30% margin of safety for Taiwan Semiconductors, strong buy rating right across the board, extremely rare. Wall Street see this at $242 over the next year, translating to 56% upside. TSM, 30% MOS, 56% upside. Do you see this as a buy, hold, or sell? And don't forget to sign up to the free weekly newsletter. Grab those spreadsheets. Come and join us in the Patreon, where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.